For Morningstar, I'm Christian Charret. Exchange-traded funds have traditionally been associated with passive index investing, but actively managed funds have been gaining in popularity as of late. Earlier this year, some major players, notably Vanguard and RBC, branched out into actively managed ETFs. I'm here today with Mark Noble. He is Senior VP and Head of Sales Strategy at Horizons ETF, to talk a little bit about this phenomenon. Mark, thank you very much for being here today.
Always a pleasure.
So, actively managed ETFs have been around for a while, and Horizons has been at the forefront of that market since the beginning, but it's taken investors a while to catch on to their merits. What do their assets look like now?
It's been a massive amount of growth. In fact, very unique to the Canadian ETF market is the fact that we have the largest amount of actively managed ETF assets in the developed world. So roughly about 14% of our assets in Canada, or 14 billion, would be defined as actively managed. And the definition that I use for actively managed is any ETF that doesn't follow a publicly available index methodology. So this would be maybe a self-replication strategy, or maybe something that uses discretionary active management. But the growth, to your point, has been about 40% per annum over the last 3 years. And even more larger has been the actual growth of the number of actively managed ETFs. We actually have about 420 ETFs in the Canadian marketplace. 130 would be defined as actively managed.
And what are some of the largest of those actively managed ETFs?
Well, what they aren't is large cap equity. So large cap equity, I think a lot of the flows we saw initially in the ETF business over the years have been trying to capture the fact that most active managers don't beat a benchmark. But we can flip that on its head when it comes to income focused categories. So if we look at what the large asset gatherers are in the active space, most of them are on the income area. And part of that has to do actually with the nature of index replication with fixed income and income strategies, and that sometimes those indices aren't as efficient. They're not built around something like market capitalization. They're built around usually outstanding debt or maybe higher yields. And as we know, if we look at that as an underlying investment metric, that may not be the best way to own those strategies. So definitely a bent towards income. And I think you're seeing that in the product side, definitely a bent towards income.
Now, a lot of these funds are fairly new, so we don't have much in the way of long-term track records. But for the ones that we do have, for the numbers that are available, what do the returns look like for some of these funds?
Well, for the larger ones, probably no surprise, done quite well. If I look at the top 10 largest actively managed ETFs, I would say the vast majority of them have performance that would be top quartile. There's two very important reasons for that. The number one important reason is actually fees. So, Morningstar has actually been at the forefront in doing a lot of education on the fact that, lower quartile funds in terms of fees tend to be higher quartile funds in terms of performance. And that certainly holds with actively managed ETFs, which charge on average for Canadian equity about 60 basis points. And if I compare that to an F-class Canadian equity mutual fund, that'd be about 1%. So I'd say on average, actively managed ETFs are about 40% cheaper than the lowest cost mutual funds. That really gives these managers a little bit less of a headwind to try to outperform. And if we look at something like fixed income, I'm going to use preferred shares as an example, that's a very constrained market, about $60 billion roughly in assets under management, but ETFs represent about $3 billion of that market. So the index strategies where they're telegraphing what they're going to be buying and selling can actually create price dislocations in that market, where an active strategy can take advantage of some of that inefficiencies to generate consistent alpha, and we've definitely seen that on an annual basis.
And are there any risks that are specific to actively managed ETFs for investors?
I would say that most of them, it's not unique to actively managed ETFs. The risks that exist in ETF investing are the risks that would exist with other types of ETFs. And the big one would probably be liquidity, because in some cases with an index product, you would see a huge amount of liquid issues because they're going to be passively buying and selling. Liquidity is a key measure there. An active manager may choose to select less liquid securities in the portfolio based on what they see. Now, they're not forced to buy and sell, but of course that could create some other issues if you end up in market impairment. Overall, I would view that as a positive because they're not forced to buy and sell, but it is a little bit of a different factor that's not there. Overall though, the buying and selling process for active ETFs and the way they're structured is the exact same as an index product. And so, you have bid-ask spreads, you have market makers ensuring that things trade close to the NAV. And again, the securities that they have to trade in do have to meet the liquidity requirements to be an open-ended ETF.
Mark, thank you very much for explaining all this to us today.
It was always my pleasure.
For Morningstar, I'm Christian Charret. Thank you for watching.